Welcome to the Daily Update, where I'll go over the action in the market for Thursday, April 6th, and then we'll see how things look for Monday, April 10th. Please be reminded that the stock market is closed on Friday in observance of Good Friday. We had a nice little rebound. We're shifting back a little bit more positive. On a short-term basis, we're still overbought and a little bit in the intermediate term, but the fact that the market could rebound was positive. However, we still remain on below average volume. The interesting thing is the employment situation report will come out on Friday. The bond market will be open for part of the day, but the stock market will be closed, so the market won't get a chance to react to this until Monday's session. So what we'll be doing over the weekend is watching the S&P 500 futures to see how they react to the overall employment situation report. Before we get started, I just want to make a couple of announcements. From April 22nd through May 11th, I will be traveling. I intend to post at least the daily videos as well as some of the other videos if I can. I do have a podcast that's available to you. It's a carbon copy of what you're watching right now. This also includes a PDF, and there are also PDFs in each description of the video itself. I do have a private Facebook group that you're welcome to join. Just send me an invitation. And I do have a poll that is posted that I'll be changing over this weekend. So let's go back and talk about what happened at the open. We had a gap lower open with prices falling below S1. Right out of the gate, it looked like, okay, here we go. We're going to keep going down. Well, we found some support below S1 at 4,075. We were able to rebound above that. We got back above the daily pivot at 4,088. We even got above the unchanged level and went positive. Prices kept rising as the day went on. We got above R1 at 4103, and we closed pretty much near the high. We were up 0.36% on below average volume, another warning sign. The technicals are still positive overall. We had been going pretty severe to the upside pretty fast. We worked off a bit of that overbought condition, and now we're starting to go back up. We'll have to see what the initial reaction is to the employment situation report, and then anything that may develop over this 3-day weekend. Inflation and interest rates are still the main concern for the market, and we're wondering, is there going to be more banking news that comes out that is negative? Here's the intraday chart showing how we gapped lower down below S1. That was the low that was set pretty much right after the open. We bounced back up to the daily pivot. We went above the unchanged level. We got up to R1, danced above that for quite a while, fell down a little bit, but then saw a little bit of strength going into the close. Here's the growth versus value chart, also showing pretty much the same thing in Thursday's session. Here's a look at the closing values where growth did outperform value on the large caps. They were the same with the mid caps and underperformed slightly with the small caps. And that's another warning sign that we're seeing, and I'll allude to a few times with the different charts throughout this video. The small caps underperforming is a concern and part of our warning signs that we're watching. Here's the intraday chart from the SPY. During the night, we were pretty much flat to lower. And then when we hit the overnight session, the futures started to come down. Then they went up positive. Then right before the open, things went down. They followed the cash market lower, then bouncing up and going positive and ending close to the high, and then drifting off a little bit into the early evening session. What are some comments that we can make? The S&P was able to regain the 4,100 level. Volume continues to be below average. That's a concern. On a short-term basis, we have the Stochc RSI, the stochastics, and the Williams percent are extreme positive. They're coming down a little bit, but with Thursday's advance, we're seeing them tick back up slightly. And these are the usual suspects. When we go in any direction, up or down, these are the first indicators that hit these extreme areas. On an intermediate term basis, I'm going to show you the TTM squeeze. We're getting a little toppy with that. Inside the PMO study, there's some overbought conditions. The CCI 20 is still extreme positive and the ultimate oscillator. The dollar was down and interest rates were unchanged to being up slightly. The home builders ETF, we're still working off of that negative divergence. We generated a signal a few days ago. It's still valid and we're still keeping an eye on that. The 30 to the 5 remains normal with all of our other yield curves being inverted. Sentiment is positive at 57, where last time it was at 52. Our trend is still positive. The green line's on top, getting stronger. We're moving above the moving average, but we're still below 20. So overall, we are in a trendless environment with a positive bias. Now, Because we had the up day on Thursday, I've switched our bias to mixed because we had a number of negative days. Plus, we have this 3-day weekend, so it's really uncertain what's going to happen once Monday rolls around. And our momentum is also mixed. We had a positive backdrop, then a few negative days, so things are still needing to be sorted out before we get some kind of a direction. The economic reports that came out, there was only one, the weekly jobless claims, and this is a little bit misleading. It came in at 228,000. They expected 203,000. Last time it was at 246,000, revised up big time from 198,000. The interesting thing is there was a revision to the seasonal adjustment factor, which resulted in big upward revisions from recent figures that we've had. Now, folks are going to look at this and go, oh my gosh, the employment's falling off a cliff. And that may be happening. But this is more to an adjustment of how things are being calculated. Now we have to see how things look going forward from here. Looking at some Isabel net charts, a week ago we had higher interest rates. That's the purple line. Now the Fed fund futures are actually dropping down a little bit as we're seeing a little bit more economic weakness. Here's the dollar index, comparing it to the manufacturing PMI. The PMI continues to decline. Will the dollar follow suit? That could give some support to stocks since they tend to like a weaker dollar. The exchange makes it look like they have more money on their books. And also internationally, that can be helpful, and that can also help emerging market stocks as well. Goldman Sachs comes out with their bottom-up consensus for earnings per share estimates. They're predicting for the first quarter they'll be down 7%. Next quarter, they'll be down 6%. But then going forward, they have pretty rosy outlooks, and that's what the market is looking at right now. If these start to get pushed down lower, that could put some pressure on stock prices. We have the Fed funds rate cuts and the max drawdown for the S&P. This comes from Real Investment Advice. This goes back historically. When the Fed starts to cut rates, what is the return during that period for the S&P 500? They don't have an average on here, but last time during the whole COVID plunge, we were down 27.61%. Now, there's another side to this where if the Fed starts cutting rates, that's seen as a Fed pivot and the market could take off and go to the upside. So you can make a case for either side depending on what chart you're looking at. The risk appetite, in yesterday's video, I showed one where the risk appetite had really fallen low. Well, now it's starting to pick back up as we've seen some recent strength in the market. Here's the latest reading from the GDP Now. Looking at the consensus for the top 10 and bottom 10 forecasts, we're up a little bit over 2%, and we're down just about 0.5 to 0.75% based on the consensus. The GDP Now continues to be falling a little bit lower. That's the green line. This chart says at the top, peak unemployment is one of the best all clear signals. Again, depending on how you look at it, we still continue to go down with the unemployment rate, and these blue lines mark the recessionary bear market low, so that could end up being positive for stocks. But then on the other hand, if the unemployment rate is low and then we start ticking up, that could be more recessionary. Another look at earnings per share says that the recession is still to come. Looking at the 12-month forward earnings per share against the earnings per share by credit and manufacturing surveys, they both are in a decline. They're below zero, so that's suggesting that earnings forecasts will continue to fall. Then Tom McClellan had an interesting chart on Twitter where he's just showing that this recent strength that we've seen in the NASDAQ 100, it's starting to really come up with the number of stocks that are above their 100-period moving average. As we've been making a higher high in the index, we're making a lower high in the number of stocks above their 100-period moving average. That is a negative divergence. David Keller, who works with StockCharts.com, also put out an interesting chart. We have the small caps up above, and they've dropped below their moving average. We've been watching that. We're down below. We have the SPY, which is the ETF for the S&P 500. He says in his tweet, the large caps are currently 2% below their February high, where small caps are 12% below their February high. And this is one of the warning signs that we're watching for. FactSet had a recent post saying the highest number of S&P 500 companies issuing negative earnings per share guidance since going back to the third quarter of 2019. Way over on the right, we're seeing a real increase in the number of companies that are lowering their earnings per share guidance, and that could be negative for the market. Then some miscellaneous charts that I came across. Here's an S&P 500 chart. This is similar to the trend line that I show in all my videos. They draw it a little bit different. where they're saying this support and resistance flip. Are we going to break through and keep going up? Or if we're coming back down, have we now hit support and will we bounce back up? Or are we going to continue to fall down below this? I mentioned in a video a few days ago about Jamie Dimon. He's the big rock star as far as the market is concerned. He came out with his letter to shareholders, and he said a once-in-a-lifetime generation sea change coming up. He says, I'm often frustrated when people talk about today's uncertainty if it were anything different from yesterday's uncertainty. However, in this case, I believe it actually is. At the bottom, he says, we may have gone from a savings glut to scarce capital and may be headed to higher inflation and higher interest rates than in the immediate past. We may be moving, as I read somewhere, from a virtuous cycle to a vicious cycle. Now, please note, this was a letter to shareholders in 2022. It's still interesting nonetheless. People listen to him. The market reacts to what he says, so we want to be aware of any real relevant comments that he may make. Now, looking at our charts, the Ulcer Index still suggests that we're in a complacent period. The VIX is also bringing that out. We're declining with the line chart as well as the bar chart, and we're below 20. VIX of the VIX shows that there's a decrease in volatilities from Wednesday to Thursday. The equity put call ratio, this has given some support to stocks. When we spiked up and start coming down, that helped the market to go higher. Now this continues to fall. Are we going to get more support out of that? Looking at this fear chart, we're ticking back up a little bit, but we're still decreasing overall. Here's another fear chart. It spiked back up a little bit, showing fear is increasing slightly. The high beta stocks, this is another warning sign. We're still more in a risk-off posture. We also had the weekly edition of the American Association of Individual Investors. I tried to change the color of this 50-period exponential moving average just to give us an idea of where the trend is going. They're still pretty bearish overall, which could give some good support to stocks. Weekly jobless claims, it has declined in the most recent reading. Where the continuing unemployment claims, we're keeping a close eye on this too. They continue to advance. Looking at our trend, we're above the moving average. The green line's on top, even though it is declining. So we are in a trendless environment since we're below 20, but we default to the positive. Our 2-year chart shows how we came up to this level. We bounced back down from that. We rebounded a little bit slightly. Can we continue to go higher on the S&P? We're still above the 50-period moving average and 200-period moving average. But looking below, we can see where volume has continued to drop off. We're coming back down into the second standard deviation on our Keltner band chart, not necessarily an extreme reading. The Stochk RSI, after coming back down, ticked back up and is now extreme positive again. The Williams percent R also ticked back up but never came out of the upper range. The stochastics, short term, still extreme positive, coming down with the intermediate term, but still extreme, and now going extreme are the long-term stochastic. And please be reminded, this is a subdivision of the short term. So it's short term, intermediate short term, and long short term. The force index ticked back up slightly and is positive. We're above all the plotted moving averages. The parabolic SAR continues to be positive. This is a warning sign. The Swinland Trading Oscillator is declining based on price and volume, but they're still above zero. The Chaikin Oscillator, after ticking down from being extreme, has now turned back up. The Vortex, even though it's dropping with the green line, continues to be positive. The Ultimate Oscillator is now back to being extreme positive, as is the CCI 20, even though it is declining. This is another concern. We're seeing the S&P not outperforming utilities, and this ratio is still declining overall. That is a warning sign. In a good solid up move with the S&P, we want to see this ratio really going up. In fact, it's going down. Ichimoku cloud, we're still above this green cloud support level. Our PMO study coming off an extreme reading with the PMOs that are rising. Turning down but still extreme are the buy signals, and we're showing a nice little uptrend with the PMOs that are above zero. BPI didn't really advance with prices but still continued to be positive overall, and it's going up and it's above 50. So this is positive. And the NYSE bullish percent index actually ticked down slightly. That's a little bit of a thing to be concerned about. The Chaikin money flow is really starting to go up strong. This tries to measure institutional buying and selling. So if this is going up, that is quite positive. The balance of power ticked back up and is not really extreme right now where it had been just 2 days ago. The CMB composite, after being extreme, is now starting to fall. The TTM squeeze, you can see when we're going up here with the blue lines, we're hitting that point where we've hit pretty extreme readings before. It doesn't mean we have to stop here. We just want to keep an eye on this. The go, no go has switched back to a darker blue, which is more positive. And our anchored moving average so far, going back to the all-time high, this moving average has provided support. Looking at our shorter-term fib levels, if we continue to go up, we're looking at the 41.25 level as upward resistance. Our longer-term fib chart also has some overhead resistance at 41.55. And our longer-term fib chart has resistance at 42.15 with support at the 40.20 level. Comparing the S&P to the S&P equal weight, this is now starting to go back up, showing that bigger stocks are seeing more strength. The Elder Impulse system for the S&P remains neutral. The McClellan oscillator, after being extreme, has now fallen, but it's still positive overall. Our broader range McClellan oscillator was sideways after being extreme. The summation index based on price and volume are positive. The new highs and new lows show that the new highs are expanding. Our moving average based on 5 periods is going up as well as 10 periods. The advanced decline line turned up slightly based on price and volume, and we're still above the moving averages. However, when we were going up, volume has been tapering off, so you could see that this is a negative divergence. The advanced decline ratio in the short term after being extreme has now fallen, as well as the red line, but we're still above zero, so that is positive. Accumulation distribution, getting a little far away from this moving average, but we are positive, whereas volume continues to taper off. The money flow index now crossed back above 50. That is positive. On balance volume turned back up and is above an advancing moving average. The Heiken Ashi, after giving us a black hammer-looking candle, has another doji-looking candle right now. So it's a little indecisive, where the Kigi chart is positive even though it's pointing down. So it's positive with a negative bias. Our Renko chart is still positive with the open blocks, and we have 3 solid bars with the 3-line break. The boom indicator, after going extreme, is now starting to come back down, measuring against the 20-period moving average. We're still holding up okay with the 50 and 200 above zero. The financials ticked up just slightly, but are still under a lot of pressure. We're getting ready to see a death cross. Comparing the regional banking sector to the financials, it ticked up just slightly, but the regional ETF is really underperforming when compared to the financial sector. Looking at some different advanced decline lines, on the top we have the NYSE, which was sideways. The S&P turned up just slightly. We dropped below the moving average with the mid caps, and we never got above the moving average and ticked up just slightly with the small caps. That's a negative divergence. The Dow is still above its 50-period moving average and chopping sideways, where the diamonds remain neutral. The NASDAQ, after looking like it could be putting in a double top here, that's still valid. We haven't come back up to this level yet, so we'll be watching that at about the 12,250 level, where the NASDAQ 100 had broken out above its previous high, hit upper resistance, and has been falling down, but had a pretty good day on Thursday. The Qs for the Elder Impulse system remain at neutral. Here's some overhead resistance with the NASDAQ 100. If we keep going up, we're looking at about the 13,618 level to the upside. We're looking at 12,868 to the downside. Here's another chart I found on Twitter. This goes back to the all-time high, and this is one of those anchored moving averages showing how we've hit the top, and this has been upper resistance, and we're right there right now. The microcaps had a pretty good day, up over 0.5%. We're watching this to see if they make a new 52-week low. The small caps were virtually unchanged in Thursday's session. Here's the Russell 2000 for the small caps. We're below 50 and going sideways with the RSI. That's negative. The MACD is still positive but rolling over. We're still below the 200-period moving average. The small caps continue to be negative with the Elder Impulse. The small cap ratio continues to disintegrate when compared to the S&P 500. And the mid-caps are still below their 200-period moving average. The mid-caps for the Elder Impulse system remain negative. And the home builders, where we've been going up and then coming back down with the S&P, we also went up and down with the home builders ETF, where the ratio has really been falling. We're still working off of this lower level spike. Even though this relationship is showing a lot of improvement, that could give some real headwinds for stocks going forward. The Copic curve remains on a buy signal, and the praying bottom fisher also remains on a buy signal. Bond yields were little changed in Thursday's session, as were bond prices. Looking at our long-term trend, we're still hanging in there. We're above this declining trend line. The MACD continues to go higher and is above its moving average, and it's also above zero. An update of our possible positive scenarios. Have 3 successive charts that just kind of gives you an idea of the condition of the market. The number of stocks above their 50-period moving average for the S&P, it ticked back up slightly and is right around 51. But if you look at the mid caps, you see it's a little bit lower. And if you go to the small caps, it's still even a little bit lower. This is suggesting that the large caps are really outperforming the mid caps and small caps. In a good, healthy environment, we want to see that pretty much reverse, and it's just not happening now. So that is another warning sign. The 10-day average of the highs minus the lows continues to go up because this is longer to calculate. So it's been drifting higher and not necessarily extreme positive yet. The highs minus the lows continues to be below zero, so that is more negative in the broad market. Growth to value ratios, seeing a little tick up with the Qs to the S&P. We're dropping off a bit with the discretionary. That could be a warning sign. And large cap growth to large cap value also ticked up. Then our growth to value ratio turning up slightly with the large caps, showing some weakness with the mid caps, and just about back on the moving average with the small caps. The 50-period moving average of the new highs and new lows, this longer term is positive. We've crossed back above zero. And here's the indicator. The longer we can stay above zero, the more this red line will stay above zero as well. The 2-year yield, as it spiked up and is coming back down, that's already given some support to stocks. Is that going to continue and lead to a broader range of an upward trend for the market? Then our staples starting to tick back up slightly. We're watching these 2 spikes here to see if a new spike will eventually be drawn or if this ratio is going to continue to fall. When it is falling, that gives really good support to the S&P 500. What's our outlook for Monday? The market will be closed on Friday in observance of Good Friday. The bond market will be open until 12 Eastern time. The technicals are positive, and in the short term, we're still giving some overbought indications. We have the employment situation report that'll come out on Friday. The bond market will get a chance to react to that. And as I said, we'll be watching the futures contract. Wholesale inventories will be released on Monday. Then the whole list of geopolitical events with any more banking information that may come out, anything weird that might happen over the Easter weekend, but inflation and interest rates remain the main scenario. We don't have any more scheduled speeches for this week. They have now been concluded. Looking at our Stock Traders Almanac statistics for Monday, April 10th, the Dow, the S&P, and the NASDAQ are pretty negative overall. The Dow is up 42.9% of the time. The S&P is worse at 38.1% of the time, and the NASDAQ's even worse, only up 28.6% of the time. But we tend to still be positive for April overall. And then here are the yearly statistics, which are adding to this positive backdrop. When we're going up further, I tend to focus more on these. When we're going down, I don't. Here's the chart showing how for pre-election years, we are in a positive seasonal time, as well as this chart on the gray line. And also this gray line is suggesting that we should be seeing stocks rising. So our scenarios can't really go with the down one because we're still positive overall, even though in the short term we are overbought. Really hard to go with the positive scenario because we are overbought in the short term, but we would default to that. However, we are not trending because our ADX, even though it's getting stronger, is still below 20, but the green line's on top, so we default to positive. So our warning signs: volume remains below average. The S&P is short-term overbought and a little bit in the intermediate term. The VIX is still showing a lot of complacency. When the VIX is low, it's time to go. The S&P is underperforming utilities. That's a warning sign. The small caps are really underperforming, and that's, as I've been pointing out, is a warning sign as well. The NASDAQ may be declining from that double top. We haven't exceeded that yet, so we'll be watching that level. The home builders continue to show a negative divergence. Even though it happened a few days ago, we're seeing if that bleeds over into stock prices. So our conclusion: the S&P is positive, but in the short term, it's overbought. Intermediate term, slightly overbought. We're still positive in the long term because we're above the 200-day simple moving average, and we had a recent golden cross. Thank you. I want to wish everybody a very happy Easter. I hope you also have a very nice weekend, and I'll talk to you in the weekly video that I'll prepare over the weekend, as well as the intermarket analysis video and the deep dive video.